best guess on time horizon to turn positive?
I will say we've done a couple things. There has never been a market rally when the Fed has been raising rates. So the question about turning positive is, when do you think the Fed is going, you hear the words pivot or stop raising rates? I would say there were a lot of people back in June saying, oh, the Fed just said they're going to pivot. And that's why you had that big, late July, August rally, because they thought the Fed was done raising rates, or they were only going to do 25 in September, and that was it. And then they got a rude awakening, and the Fed's raised 75 and said they're going to raise more this year. So what we're looking at, that we're thinking three things we're looking at. What are interest rates doing? What are earnings doing? And seasonals. I'll do the seasonals first. That's easy. Historically, September and October are the worst seasonal aspects of the market. So we're not going to be jumping in. There's a seasonal reason to give some time. Two would be earnings. Remember how I said earnings do not reflect a recession. They've come down, I think, maybe 5%. So where we might get interested saying, oh, it's overdone or it's oversold or everyone's worrying about recession, is where we see earnings down 10, 15%. We're not there. And then when interest rates have stopped going up, and I'm pretty sure, I'd be willing to bet the Fed's going to raise rates. There's 2 more Fed meetings left this year, and both those are expected to raise rates over 100 basis points.
Over 100?
Over 100. They're like a 75 and potentially a 25 or 50-50, depending on how they want to word that. So that there's a lot of aspect about that. But I will say 2 things about on the positive side. Once the seasonals pass, usually November is a great entry point for most times in the market. November, December through the first half of the year usually do very well. And so that's one thing. 2 is we're closer to a interest rate stoppage, or the Fed's done raising rates, than the beginning. And historically, when the Fed's stopped raising rates, the markets over the next 2 years tend to go up 15 to 30%. So there's a silver lining at the end of the day. It's just we're not at the end of the day yet. It might be 4 o'clock, 5 o'clock. I don't know if it's definitely not 8 o'clock at night yet. But what we're doing here at Fundamentum is we have raised our cash. So now we're looking at what are we going to do to deploy that cash, and what stocks and what funds are we going to buy. So we sort of made our how to say it, a buy list of these stocks, whether they're a growth stock, whether they're a value stock, whether in one industry or the next, or whether they're a fund that looks interesting. That these are the things that we're doing right now to get prepared for that.
Okay. All right. Well, thank you for answering that in such detail. Are you seeing some pretty good opportunities out there nowadays?
I think in fixed income, there are lots of opportunities right now. In equities, it's a little closer. For example, my biggest concern on the equity markets is earnings. And if earnings go down, that's actually going to be good for bonds, because that implies we're into recession. So I think there's a multitude of investments, whether they're funds, whether they're treasuries, the 2-year bond rate is yielding over 4%. That's an outstanding investment that does not have any credit risk right now. That's yielding you 4% right now. Even the 10-year at approximately 3.5, 4% is fairly good. You can start constructing portfolios with bonds that are paying you nice income that give you the anchor or the diversification you need for your equities. So I think there's some interesting aspects there. On the equity side, there's always going to be pockets that you can look in. I mean, the credit cards look interesting with people buying, increasing their credit card purchases. But at some point, that could become a risk if they can't pay for their credit card purchases.
Yeah.
So you got, I would say technology stocks always have a growth potential. So they're always there. You just got to make sure what you're paying for that growth is what matters.